Okay. Hi, it's Josh Brown. I am here live at the compound with Michael Batnick as usual and our special guest, Michael Arone. Michael is the chief strategist for State Street's SPDR's business. You might know SPDR ETFs. Michael is a deep thinker. He comes up with surprises every year. His record has been incredible. He's gone 10 for 12 since 2016. We're going to talk about what he expects for 2020 and how he's so good at this. Stick around. Let's see what's going on. All right, so Michael, thank you for coming. We appreciate it. You came down from Boston.
That's right, from Boston. My pleasure. Thanks for having me.
Oh, it's our pleasure. And you've been with State Street for 23 years, you told us?
That's right, 23 years. I started when I was 5 years old.
Yeah, good for you. You really grew up there.
Yeah, absolutely.
All right, so before we get into your three surprises for 2020, one thing I quickly want to point out, I'm sure your kids have already. You said over the past 4 years, I have accurately predicted 10 of 12 surprises. My two teenage kids would call that a humble brag. That's actually just a brag. The humble brag is like, I went to the gym and they ran out of weights for me. Right. So I guess I have to find a new gym.
Yeah, look, I was trying to get some credibility with my teenage kids. It's not easy, Josh, you know?
I appreciate it. But 10 out of 12 is really good. So I think what you're trying to do is say something non-consensus about what could happen that people would be surprised by. They're not outrageous, but where do you even start? Because it's tough. I think most people think about forecasts, and it's like, where do you even begin?
Right. I make a lot of jokes around the whole fallacy or the fool's errand of forecasting throughout the document. I think what's interesting is I try to really teach the lesson to investors over the last few years that outcomes, returns, are uncontrollable. But process is controllable. And the process that I've used to go 10 for 12 has stayed pretty much the same. So Josh, I do a few things. I keep it pretty simple in terms of three surprises. Those that are trying to forecast 10 in every single market, you can forget about it. The other thing is I keep the time horizon short. 1 year, 1 calendar year. That's all we're looking for. We're going to keep score from the beginning to end of calendar year from that perspective. It's not some long-term forecast. Those are somewhat useless. And then I look, as you're rightly saying, I look for things that are wildly out of favor, where everybody's loaded up on one side of the boat, right, and sentiment is one-sided. Now, it can be good or bad. Doesn't necessarily mean, but sentiment is decidedly one way. And I look for compelling value opportunities, things that are likely out of favor or non-consensus. That's where the best surprises come from.
What if I said, though, if I had 10 or 12 surprises, it's almost like diversifying your portfolio, like more things could come true?
Right, but I think what happens is you give up with diversification. You give up some of that accuracy. So I'm not diminishing the benefits of diversification in a broad portfolio.
Doesn't
he do 20?
He does 10, I
10?
think.
Okay.
Yeah, and it's great. I'm not criticizing the approach, but here's the thing: the more you forecast, your hit ratio is going to go down automatically. So from a diversification standpoint, you're in a diversified portfolio. With most of our clients are in a diversified portfolio. But when it comes to picking surprises, you keep the number short. Your accuracy, your ability to pick those surprises goes up, in my opinion.
With 3, the worst you can do is 0 for 3. You
That's
don't
right.
You don't want to go 0 for 10.
No, yeah, absolutely.
And then this idea of like giving yourself that advantage of being on the other side of the boat from everyone else. I don't know that it helps the forecast come true, but maybe you're just like stacking the odds in your favor a little bit more because of how lopsided the opinions on something are.
And we'll get into that as we go through the surprises. You can see that in some instances, the odds are kind of in my favor, if you will, based on historical precedents.
Because something is so cheap, it would be almost hard for something to go wrong.
Right. So the margin of error, the margin of safety,
I agree with that.
is pretty hefty.
I agree with that. All right, so let's get into this. So the first thing you're saying, which I completely agree with, is that it's hard for a bull market to finish without that euphoric phase. I think a lot of people would agree with that, but then some people would say, no, it's already happening. Look at Tesla, look at Bitcoin, look at, name your thing. So how do you know that hasn't started yet? And what is telling you that 2020 is the year where the euphoric phase of the bull market finally happens?
So there's a few things. Headed into this year, most Wall Street forecasts are for that traditional 5 or 6%.
That's every year.
Every year, right? You look at the earnings, you're going to get 4 to 6%. You're going to get the dividend yields of like 1 to 2%, 1.5, 2%. And last year we had tons of multiple expansions, so we're not likely to repeat that. 5 to 6, 7%. Classic forecast. Now, here's where the odds and probabilities are my favorite, Josh. If you look at historical returns over the last 90 plus years, do you know how many times the S&P has finished between 0 and 10%?
It's like 3% of the time.
17% of the time.
17, okay.
Do you know how
I
many
knew it was
times
low.
do you know how many times it's finished between negative 10 and 10? 28% of the time. Do you know how many times it's finished more than 10% or greater? 51% of the time. Right. The odds are in my favor. So forecasts are already underestimated from that standpoint.
So the average return, it's an amalgam of those huge good years and then the handful of down years.
Exactly.
It doesn't come because on average we see 7% a
It's
year.
rare for the S&P to single digits, and yet every asset manager, every Wall Street analyst, like the strategist, suggest each year, hey, 5 to 10%. It just seems like a reasonable
It's
figure.
how you keep your job.
Absolutely, and I'm not criticizing. We do it too, so I want to be very clear. We do the same type of thing.
Right.
But the odds and probabilities tell you that the likelihood is that it's going to be something greater than that.
So it might feel like this is a hated rally. Like you don't really feel the sentiment exploding, particularly coming down from Wall Street. You're not seeing it. But the obvious pushback here is S&P was up 30% in 2019. So wasn't that a melt-up?
So the returns were great, but we still haven't seen that kind of wild capitulation in a positive way.
Do you mean like people day trading like 1999? Like does it need to get to that level of...
More like the flows. So Michael, just look at last year, exchange traded fund flows. Bonds actually had more flows than equities. Look at what's happening in the mutual fund industry. Flows have been kind of outwards for years. And institutional investors continue to be kind of defensively positioned.
Isn't the flows, though, about demography and the boomers spending down their portfolios?
Yeah, what if this is permanent? That's what I was going to say.
Perhaps you're talking about a structural change in market due to demographics. Could definitely be. But again, we're lacking that euphoric moment in terms of
okay, so can you
meltdown.
quantify what does a euphoric moment? Because I was mentioning to you before, yesterday there was an article in Bloomberg. People are getting Dow 40,000 in license plates. I can point to Tesla. I could point to the top 10 holdings on Robinhood. I could point to these things and say, I know it when I see it. There's euphoria, but that's not like science. We could talk about hemline indicator. I don't even want to go there.
Yeah.
How do you definitively say this is euphoria, this isn't? What will it look like in numbers when we see it?
Right. And so I think the classic metaphor, right, is the patriarch of the Kennedy family, Joe Kennedy Sr., said when he was getting tips from the shoeshine boy, he knew it was time to get out.
Yeah.
I often joke that when I get in an Uber and I'm getting tips on how much money the folks are making in the market, probably a good sign of a top. But in terms of data, I'm looking for things like S&P 500 futures positioning right now is the highest it's been since 2013.
So it's starting to bubble up.
In my view, there's some signs that this could be occurring. You look at the put-call ratio from that standpoint. It reached its highest point in more than a year at the end of January, despite some of the risks.
Put-call ratio is a measure of how many people are placing bearish options bets versus bullish.
Exactly.
So when
there's
you say
more
the
call
highest,
buying than put buying,
right.
And that ratio is at its lowest level, signaling extreme bullishness.
Okay.
Biggest amount that we've seen in a year. And this is at a time when election kind of concerns about who's going to be the Democratic nominee and coronavirus slowing growth, and this is still happening.
Right.
$46 billion into equity ETFs so far in the first few weeks of this year. A very strong sign. So there we're starting to see a little bit of that shift from that perspective.
So the beginning of the year, this is my personal opinion. I've read both versions of this, but I feel like it's really important to discount January flows or outflows into or out of anything, because I think, especially when it comes to ETFs, financial advisors are driving most of the activity. And a lot of them are doing rebalances or portfolio reconstitutions. And what you see happen in the first month of the year doesn't necessarily mean what you'll see happen for the next 11 months of that year. Do you agree at all with that statement?
I agree, but here's the really interesting thing. As Michael pointed out, with an S&P 500 return of 31.5%, if they're rebalancing back to strategic weights, they'd be selling.
Okay,
and
that's
yet
a good point.
they're buying. So I agree with your point, Josh, but I think that's an interesting contrarian.
So it sounds like you're saying that the onset of euphoria is now underway.
Potentially. So I don't pick exactly when it's going to happen. I just say in 2020, this calendar year, we should see it. One of the plausible theories is that after the election, if the markets likes the election outcome, you could see a spirited year-end rally to push us up kind of meaningful way, that 10 to 15% or more.
So you're in the Boston investment community. You probably have lots of friends that work in the investment business. Are you seeing them act differently than they did 2 or 3 years ago, or like are you seeing signs of euphoria in your own life, in your interactions with colleagues that work in the industry?
So
I'm
far,
really not.
So far, no. I think
Okay.
sentiment continues to be somewhat cautious. Even if you look currently at the exchange-traded fund flows, it's very barbell or bifurcated. So we're seeing heavily flows into technology, communication services. So as the price for growth has come down, or expectations for growth has come down, growth trades at a premium, people buying it up. But that's paired off with big flows into utilities and REITs, for example, bond proxies with income and defensive plays. So I haven't really seen that euphoria from investors just yet.
But what if like the S&P has been up, I think 10 of the last 11 years? Do you think that it's the case that people just don't want to be embarrassed and look silly? Like to turn wildly bullish at this point, like just seems like a low risk reward type of thing, or high risk reward.
I agree, Michael. But here's the thing: I think in order for the bull market to end, you need euphoria. So there's the famous Sir John Templeton quote about bull markets: born on pessimism, mature on skepticism. Grow on skepticism, mature on optimism, and die on euphoria. And so that euphoric moment, this is one of the most unloved, most skeptical investors are the most skeptical about this bull market ever. So I think you need euphoria before the bull market ends, and we just haven't had it.
In 2017, we had an incredible year in the stock market. We were up like 27% in the S&P.
Yeah.
I did a piece, Where is the Euphoria? And what I concluded was that euphoria doesn't start with individual investors. It starts with the pros, and then it emanates outward.
That's right.
The pros are losing their jobs. Like, this is the first rally in the history of Wall Street that didn't result in a hiring boom and a bonus boom because of, I'm not blaming State Street, but the popularity of passive investing strategies coinciding with this bull market. You may never get the euphoria in this case because of how pessimistic Wall Streeters are about their own career prospects, and actually perversely rising prices each month in the markets that they are not benefiting from because fees have been cut to 5 basis points actually makes them even less likely to get euphoric. What do you think about that theory?
Long live the bull market. Again, I think without it, it's going to be hard to see an end. As we say, markets don't die of old age.
So it's
that
prolonging
skepticism, I think, prolongs the bull market.
Okay.
And in our opinion, there's no clear signs to end the bull market. Now, typically, an exogenous factor might, right? And I don't know about you guys, but I don't have my crystal ball with me. So those are hard to predict. Other than that, it's tighter monetary policy or some type of policy mistake. And so those don't seem kind of evident at this point.
Or inflation.
Inflation.
Also,
so again, coronavirus is certainly going to take out any fears of inflation from that standpoint have been diminished as we start the year due to coronavirus for sure.
So I want to do this one quickly. The second surprise, the healthcare sector could be the top performing of the 11 S&P 500 economic sectors. I love this one. I hope it works out. I'm actually surprised, given the demography of not just the United States, but China, Japan, Europe, that healthcare stocks aren't the top performer every year. I just think it's like this built-in tailwind of demand. But you point out, and I want to get your comment on this, healthcare trailed the S&P 500 index return by almost 11% last year. It was the second worst, other than energy, which we know is the worst. But it's now the second cheapest of the S&P sectors, healthcare. And it's reporting the strongest fourth quarter year-over-year revenue growth of all the sectors. It's expected to report 10.6% year-over-year revenue growth, which is like secular, non-cyclical growth, basically.
Right.
And it's getting no credit. What do you think is going on? Is it like just Bernie Sanders fear? What's going on here?
Well, it's not just Bernie Sanders fear, but that certainly has a big part of it. You saw the stocks trade negatively when Elizabeth Warren's prospects were rising in the polls. Subsequently, as they fell, stocks rebounded some. So certainly the political overhang is a key risk to healthcare, and one of the things that's dampening it. Now, there's drug legislation that's trapped in Congress as well that's providing some uncertainty from that standpoint. And certainly kind of mature drugs and kind of new pipelines from that perspective for mature pharmaceutical companies is a concern for the pharmaceutical industry specifically. That said, though, underperformed, $5 billion in outflows to healthcare exchange-traded funds sectors in the last 12 months. So people don't like it. Second cheapest, you look at free cash flow yield, it's the second cheapest. And the thing here is, unlike all the other sectors, analysts have been increasing their expectations for revenue growth and earnings per share growth.
Yeah.
Where many other sectors, they're slashing them. So here you have something where the fundamentals are improving, the trades at a discount, and you have the structural benefits that you mentioned, aging demographics, longer lifespans, that should be a long-term tailwind.
So 2 follow-ups. I know you're with the spiders, so you're never going to say anything overly disparaging about sector composition. But isn't this a case where it's just the wrong stocks are the biggest weighting? Because if you look at the fear about drug pricing, you could understand why that would constrain large cap pharmaceutical companies. But then look at the rest of the sector, like all the medical device stocks are at 52-week highs. All of them have doubled in the last year to 18 months. Some of the best performing stocks in the market, they're just not as big as Pfizer. Right. So is the sector return not really telling the story of how well stocks in the sector are doing?
Well, I'm not sure I'd agree with that. I think the market cap weighted sector is the benchmark that most investors use to gauge on how they're doing. Now, you make an interesting point, Josh, and here's where we do make a distinction at SPDR ETFs, where we have our industry ETFs. Those are equally weighted.
Yeah.
So, for example, on a place like biotech, if you're owning market cap biotech, you're owning 4 stocks. So for us, in our SPDR Biotech ETF, it's more equally weighted. XBI. So therefore, you have a,
it's like
a
40
greater
stocks,
distribution.
2% each.
Yeah, you get access to small, large, and mid. So you get access to the M&A activity. Someone comes up with a blockbuster drug, fantastic. So again, if you're going to buy something where 4 stocks make up 80, 90% of the cap, buy the 4 stocks.
Right. If you buy market cap weighted biotech, it's like Amgen, Celgene.
Exactly, Biogen.
Okay.
So our view is that we have 2 kind of ways in which to invest. You can use the sector, which is market cap weighted, or you can use the industries, which are equally weighted and helps offset some of the structural challenges that you described.
Last follow-up on this. Why not just get your courage up and instead of the second cheapest sector, just go for energy?
So
just go all the way.
Here's the thing with energy. There's lots of bulls to start the year, not working out for them so great. So my view is that with global growth still very sluggish and coronavirus only going to make it worse, the demand for energy is still going to be pretty modest. Supply continues. So if you're bullish energy, you think we're peak shale. I don't think we're there yet. I think we can continue to turn on the spigot from that standpoint. Alternatives to energy are cost effective and easier to get than ever. I don't know about you, but in my neighborhood, we got solar panel, people buying solar panels. They're only going to get more accessible, more cheaper. Fuel efficiency, our cars, every product that we use, I think of it like agriculture. We used to get so much yield on crops off a certain set of land, and then we shrunk that amount to get even greater amounts of yield. Same thing with fuel. The things we use today are more fuel efficient than ever.
So you just don't see that being coming back this year.
I don't think so. And one of the things I often joke about, right? If the Saudi government is trying to pivot its entire economy away from oil,
what does that tell you?
What does that tell you about their forecast for oil? And do they know it? Do I know it any better than them? No way.
So, quick comment on the third surprise: the confluence of events that lead you to believe the dollar will remain strong this year.
Looking good so far.
Looking good so far. A lot of that's certainly a flight to safe havens due to some of the kind of geopolitical risks, the coronavirus, that type of thing. But here's the thinking in terms of going into the year, every investor survey suggested the dollar would fall. The logic is great, makes sense. Fed was cutting rates, yawning twin deficits, budget and trade, Trump administration's talking down the dollar. You'd expect. And now folks are at the beginning of this year expecting a reacceleration in growth outside the United States. So now they're starting to flirt with EM.
So I was going to ask you, what's the implication of if the dollar does not weaken materially, stays around where it is, what is the implication for foreign stocks, for fixed income?
It's a headwind for both international developed and EM, and multinational companies who are expected to grow earnings at a much faster rate than domestic companies this year. It will be a risk to all of those investments. Doesn't mean they're bad investments, but it will be a headwind for them. So here's the thinking on the dollar. If you think about it, even at about 158 on the 10-year Treasury, that's what we're about today,
right.
Still we have Germany and Japan that have negative rates. UK and Australia, we're still much higher than them. There's lots have been written about Greece is actually, much lower, right? It used to be 40%, now it's like 1%.
Yeah.
So our rates still, even though they're low from our perspective, are much higher than everywhere else. So that's going to attract dollars. The second component, and I'll do this quickly, is growth. If you look at the IMF forecast in the beginning of January, so they did expect the US to slow to around 2%. The euro area is growing at 1.4%. The UK at 1.3%. Japan at 0.7%. This is where the interest rate differential is. This is where the growth is in the developed world. We will continue to attract dollars. There is a conspiracy theorist out there, and the crypto folks, they also believe that there's a shortage of dollars.
Dollar shortage.
Absolutely. Right. So all three of those things, I think, will benefit the dollar, keep it more elevated than most expected heading into this year.
All right. Our guest is Michael Arone from State Street. Where can people follow your research? Just go to like Spiders?
Spiders.com.
Okay.
And also on LinkedIn, the Unconventional Investment Strategist.
Okay. Will you come back in December so I can yell at you about everything you got wrong?
I don't know about yell. I'm going to take a victory lap.
All right. I love it. Listen, follow Michael's stuff. He's been pretty right so far. And I really appreciate you coming in. Let us know what your thoughts are on these big surprises for 2020. Leave us your feedback. We love to read your comments. Michael loves most of your comments, but I love all your comments. Go ahead and give us a like if you haven't already. Make sure you're subscribed to the channel. We will see you soon.